Stock Markets for Beginners, Part 9. In this section, we're going to talk about how Warren Buffett actually picks his investments as value investments. We're going to show you how to use a stock screener. That way you can narrow down the thousands of public companies to just a few to look further into and find the best investment for you, and how to determine a competitive advantage within a company. That way you can pick investments that have the highest likelihood of long-term growth and a high investment yield for you. This is a very exciting section, so let's go ahead and jump right in. So now we need to narrow down our choices. We understand what stocks are. We understand financial ratios. We understand financial statements. We understand what risk is. So we need to take all of this and put it into a real world example, narrow down our choices, and understand which company we may want to think about investing in. So we're going to do this kind of Warren Buffett style, how he would take a look at a company, whether it's valuable or not, and then do a competitive analysis to see, does this company have a competitive moat around it? Is it hard for other companies to beat this in the long run? Because Warren Buffett would want to buy for a relatively cheap price, buy a great company, hold on to it forever through the grave. So we're going to narrow down our choices. In order to do that, the easiest way is by using a stock screener. So here in the computer, we are up on FinViz on their stock screener. I really like this stock screener specifically. And I put in some criteria to narrow down our choices, because this starts with every single public company, and you want to narrow it down to just the few that you really want to look at, because we're going to spend a lot of time digging into the financials and what this company is all about. So you want to make sure that you're starting with a company that has good chances of you wanting to invest in it. So just covering the criteria quick that I'm looking at here. I did the market cap over $300 million, which is pretty small. Dividend yield over 2%. We know what dividends are. I did the country, USA. Now you may want to do foreign countries. You may want to do a completely different search. This is just a Warren Buffett style search. And if we go up to the fundamental tab, this is where we use the ratios. So we're looking for a PDE of under 15, a current ratio of over 1.5, a price to book of under 2, and that's it. Just those few criteria, that narrowed down every single stock in the entire stock market to 14 options. 14 options. From here, we can take a look at these 14 options, choose maybe 5 or so, and really dig into those 5. Now, we can see Tyson Foods, that company that we were talking about earlier, is on here. So of these 14 companies, the one that jumped out to me as most interesting was Viacom. So I went ahead and put all of the data from Viacom onto this spreadsheet. I pulled all the data, put it on this spreadsheet. Also, if you like this spreadsheet, after we do this little analysis, the download link will be down in the description. It's completely free. All I ask for is a like, a subscribe, maybe a share on this video. You know, it's up to you. So the first part here is just the basic stock screener criteria. We're familiar with all of these ratios. We're familiar with everything here. And we know that Viacom hits these criteria because they were as a part of the screener. So we know that. And then we have the competitive advantage aspect. Warren Buffett looks for a competitive advantage. Is there a moat built around this company that is hard to beat by competitors? So there's a lot of different ratios that we can use in order to help determine, hey, does this thing have some sort of competitive advantage? The first one is gross margin. I have notes here all on the sides as to what each of these is. So gross margin used to analyze a company's efficiency in producing and distributing its product, and how this is calculated. So we have a gross margin here of 39%. SGA to profit, that's selling, general, and administrative to profit. With this ratio, you want to take a look at the financial statement and make sure that it is relatively stable over time. If the selling, general, and administrative is staying the same but profits are increasing, that is a great sign. Research and development to profit, in this case, they didn't have a whole lot of R&D. Depreciation to profit, we have a ratio of 40%. You want to do a competitive analysis for this. You'll want to pull their closest competitors and see, hey, how do they fare? Receivables to sales ratio, 27%. Again, you want to compare that to competitors. Return on assets ratio, we're at 4.39%. We really want that up over about 5%. But with this, it doesn't have to hit every single one. It's more like a grading scale where the more the better, but if it misses one or two, that can potentially be okay as long as it makes up for it in a different area. Return on equity ratio, we want this between 15 and 20%. We're sitting at 15.03. That is great. And again, you want to compare all of those to their closest competitors. That way you really see where they stand. Because if you have a company that is in a healthier financial position than its competitors and it's selling for a relatively cheap price, that is a company you may want to buy. And then we have a few other things here. Interest expense, how much are they paying on their debt? You can find this on the income statement. What is their net income compared to revenue? 9.1%. Again, you want to compare that to competitors. What are the earnings per share? So earnings per share, you really want to see that stable stair step over time. I wrote chaotic here because with Viacom, they're kind of all over the place, but they are trending upwards. Cash on hand, 2.98 billion. Cash on hand can mean a couple things. It either means the firm has a competitive advantage, which you want to see, or the company sold off a business or a ton of bonds, which could potentially be bad. Inventory, with this company, they don't have a ton of inventory, but if you see the inventory increase and net earnings increase at the same time, that is a great sign. Goodwill, typically, if you see a big jump in goodwill on the financial statements, that means that there was some kind of acquisition, so that's something to consider. Additional stock, if you see treasury stock, that's a good thing. That means the company is buying back their own shares, which effectively means your shares are worth more money. Preferred stock generally isn't great to see. Generally, great companies don't have preferred stock. And then investments and debt. I like to see a company who can pay off all of their debt with net earnings in 3 to 4 years. So in this case, it's 9.22. So it's not the greatest, but sometimes other ratios can make up for pitfalls like I mentioned earlier. But then this isn't the full picture. You want to take this, you want to compare it to competitors, you want to compare it to industry averages, and you also want to compare that industry to other potential industries that you can invest in because you want to put your dollar in the area that has the greatest odds of future success. So there's a few other things that we want to take a look at when analyzing a company. First off, who is the management? If you go onto this company's website, on any public company's website, you'll be able to find leadership. I like to look at the leadership and see what they've done in the past, especially if there's new leadership. I really like to see who they are, what they're all about, because they're the ones who are leading the ship. I also like to take a look at competitors, like I've mentioned, industry analysis. You can a lot of times type in the industry and see what the growth trends are and the projected growth trends. If the projection is very high, then it may be an industry that you want to invest your dollars into. News catalysts. I really like, before I buy a company, to check out basically all the news articles I can find within the last 6 or so months, just to see what's going on, what's up with the company, is there drama, what's the general consensus. And then earnings calls. This is huge. Every quarter, public companies do an earnings call where analysts can come in and ask the executives questions. I can't stress how great it is to listen to these calls because you can actually get a sense of the executives, where they're at, and kind of almost who they are as people. And it gives you a lot more context around the numbers that we're looking at. It is extremely helpful, so I strongly recommend taking a listen to a couple earnings calls before you dive deep into a stock. And if you do all these things, is checking all your boxes, then maybe you want to make a solid investment in whatever company that you're narrowing down if you're aiming for a value investment. And there you have it. I can feel you slowly building up this ball of knowledge that's rolling down a hill, picking up these concepts that maybe you've heard mentioned here or there, and now it's all kind of sticking together. On part 10, we're going to talk about a different method for finding stocks, technical analysis. We're going to show you how to actually buy a stock and the different order types, a market order versus a limit order. That's over in part 10, so make sure you give part 9 a like, make sure you hit the subscribe button, and if you want even more exclusive content, join the Patreon linked down below for things like private live streams, private videos, buy alerts for my various investments, and we'll see you over in part 10.